All right, so welcome back. It's been, I don't know, it's been a couple weeks since I've been on. You did one with Cash without me.
Right.
Down day on the market. Uh, kind of been expecting something like this after the action we've seen past couple of days. All the momentum stocks getting slapped around again. All sorts of bad breath in the market. We were talking about in our newsletter today. We added hedges yesterday. Um, we'll see. So far, and all of these dips have been viable. We'll see if this one is. At some point, it won't be, but so far, so good. So, what's going on, Pat? You want to introduce our guest?
Yeah. Hey, everybody. We have Eric Jackson on, known as the 100-bagger guy. Talks about open, which we have on here quite a bit. Eric, where are you at? What do you think? Where are we going? Et cetera, et cetera. How you doing? Also, you're a Blue Jays fan. Sorry to hear about that. And I'm in LA, so
Yes.
Too bad.
I'm a Dodgers
Okay.
guy in theory.
All right. Well, it was quite a game. I was there. I was there on Saturday night, and I was standing next to a Dodgers fan. And at the end of there were very few, but it was pretty shocking. But at the end of the day, I had to shake his hand and slap him on the back. And they're a great team.
Right.
It was fun.
Right. Yeah. So, what do you think about the market, man?
So I'm very bullish. I don't trust all these nervous Nellies that you seem to hear all the time on TV and on Twitter talking about how we're in the middle of an AI bubble and everything's about to crash. And I don't own Palantir, but it does look expensive. I have to admit, on lots of metrics. But I think we're still in the very early innings of the build out in AI. We're at the beginning of this rate cut cycle with two rate cuts in the books. So just getting started on that front. And I am of the belief that this rally could go on for, several more years, well into the 2030s. We saw similar kind of hatred for the rally coming out of the great financial crisis. I mean, I think every year for about 5 years, people were complaining that the Fed was screwing things up, and we were about to just revisit all the all-time lows and all this kind of stuff that we saw in 2008, and it just never happened. We just kept crawling up a wall of worry, and that's my quick take on the markets these days as well. I think we're nothing like we were in terms of the craziness of 2021, let alone .com.
Cool. Yeah. No, I don't necessarily disagree. I think there are certainly some parallels, but a lot of a lot of differences. And I'm still bullish, but short term, I certainly think it might behoove people, and we always teach people, always have hedges. And I think short term, it may behoove people to ramp those up a little bit while we kind of digest through some of what's going on, and then get ready for another leg higher, hopefully.
So
Well, it's been a good run since what, April 23rd or something like that?
Yeah.
So tell us about Open Door, and like
That-
you also like Rocket, right? Are you guys hearing me?
No, I like Open Door, and I like Better Home and Finance actually a lot more than Rocket. So they're more Better is a direct competitor to Rocket. They're all obviously housing plays, and so I think in general, like the housing plays and the Russell 2000 in general they haven't yet had their due. Although you could say Open's certainly had a great run the last few months. It was 51 cents at the end of June. It's now like 7.50 or something like that. So obviously,
That's a nice
but
run.
that's because they had a terrible CEO, and they were sort of priced as if they were going out of business and all this kind of stuff, and about to be delisted and everything. And so now just having competent management has sort of taken them back to where they are. But in general, the housing plays I think are just at the beginning stages. Rocket's the leader, and they recently had really good earnings. didn't do that much to help the stock. But they're the number one player in America. I think they only have like a 6% market share nationally. So it's a big market. There's lots of opportunities, and the kind of the competitor or the upstart that I like, that I think has a way more upside than a rocket is Better Home and Finance. So Better is much more similar to Open Door in the sense that it was another left for dead SPAC that just people forgot about. They, unlike the other SPACs, didn't come public until 2023, which was kind of surprising because almost all the big SPACs that we know came out in 2021 in the heyday. But you guys might remember that Better kind of got famous. If anyone's ever heard of Better, it's usually because they say, "Isn't that the company where the CEO fired like 1,000 people on a Zoom call?" Right. And that's literally what happened. That was Vishal Garg, who in December of 2021 let 1,000 people go, who are all like outsourced folks in India, who were basically, their job working for Better was pushing paper to kind of help push out commitment letters to people in response to the low rates, the ZIRP rates, and get mortgage commitment letters out to people. Better is sort of like a matching engine. They originally kind of built an AI system going back 10 years ago where they hired away the AI engineer who had worked at Spotify and built the original music matching algorithm. So they took that Swedish guy, popped him into Better, and said, "Hey, we got a more complex matching problem for you. It's like matching people and all the credit scores and everything to kind of the lowest, the best kind of mortgage for them, whether it's from a bank or credit union or what have you." And that's how they started. But in the 2021 heyday, they were still reliant on humans, 1,000 humans over in India to actually push paper to, fulfill volume. So they did something like 54 billion in mortgage originations in 2021, which sounds amazing or phenomenal. It was a huge number. But what's even more shocking is that they could have that year done 240 billion plus of originations had they had a fully automated system. Right. And they couldn't, so they were sort of human constrained. So they did 1/5 of the volume they could have. Still, it was a huge number. Had they had a SPAC in that at that moment, they would have been worth a bunch. SoftBank owns like 17% of them, thinking that they're going to be the new king of mortgage originations. But then rates rose, volume dried up. They went from 54 billion in originations as a run rate to 5 billion by the end of that year, and that's why the CEO had to take that kind of necessary action of letting a bunch of people go all at once, even though it came across as heartless. But they've spent the last few years, kind of taking the AI system that they had, making it better, making it essentially fully automated so they don't need the human folks that they used to have to rely on. So it's kind of like a perfect mini case study for the response to the AI bears who say, "Oh, it's only the Mag 7 that's spending money on this stuff. And when am I gonna really see the real life examples of how AI is transforming things?" Well, here's a real life example. Hasn't manifested yet really in the stock price of Better, but they could, and they don't require things to go back to ZIRP, but just assuming that they go back to, the 30-year average of basically 200 bips less on the mortgage rates than where we are currently, that would probably take them back to volumes like, 200 plus in originations. And this time with the AI system that they have, they could handle it all. So I think, everybody sort of just forgot about them, just like they forgot about Carvana, just like they forgot about Open Door. Once these public companies stumble, and they're down 90+%, Wall Street drops coverage, everybody sort of just walks away. It's as if they have the plague on the other side of the room and they don't want to kind of spend any attention with them. And yet, if they really, have a sound business model, a good technology, good management, they can, sometimes be the proving grounds of these like true 100x type opportunities, like we saw with Carvana. So Better is just getting started. It's at sort of like I don't know what it is, like 4x for me personally. It's had a decent run just in the last I don't know 6 months since mortgage rates have started to fall. They have earnings coming up next week, which will be interesting because it'll be a sort of a solid kind of evidence of just how sensitive their business and their volumes are to just a slight dip in rates. They also have a HELOC business, so obviously that hinges on that as well. So that's why I like better BETR. But that's been a more recent play. The original kind of play this year that was sort of like my next Carvana was Open Door over the summer. So that's again, work in progress. They have earnings later this week, but they've got a brand new CEO, the former COO of Shopify. So it's been interesting from a bunch of angles in terms of how they're currently retooling. But these 100 baggers don't happen overnight. I mean, it's stages and stages, and so it'll be interesting to see how both these companies do with these kind of upcoming earnings reports in the next week.
Right.
Are you typically, because it's interesting, so we run a SPAC ETF, but it's a pre-merger SPAC ETF. So, we're, in all of those things until they de-SPAC. And interestingly, we used to run an inverse de-SPAC ETF, and in 2022, it was the top performing non-levered ETF out there. All of our names were trading like under 2. And interestingly, if you look at like a lot of the names that are really leading this market this year, it's those same names that were, that got on, a lot of them under 1 and are now at, 7, 8, 100, whatever. Are you typically looking at some of that? Because it sounds like that fits the bill from the standpoint of, all right, this thing's trading at 50 cents, no one's paying any attention, and it would seem like if you know what you're doing, you can get some real alpha there.
Yeah, I like, as you said, like my kind of my mantra is that I'm trying to find these 100 bagger opportunities, which is tough, admittedly, in the public markets, especially when you've got all these private companies like OpenAI staying private until they're $1 trillion market cap. I mean, it's ridiculous. I wish it was more like the .com era where everybody was just like basically going public with a business plan, no revenue yet. That'd be easier to find the 100 baggers in that kind of environment. But so there's sort of two pots or two pools where I typically find these opportunities. One are the sort of Walking Dead zombie companies, forgotten about, down on their luck, 90% plus down. And there's no question that there's a lot of, pickings in that category of like, de-SPACed companies that have just fallen off a cliff. And then the other pool that I fish in is just sort of like the undiscovered, like unknown companies. So there's a company that I own or have owned for, since December of last year called BTQ Technology. So it's a post quantum cryptography company. So it's a quantum play, but instead of building their own quantum computer, they're basically building the hardware and software to kind of protect against quantum attacks, in a few years from now. So they have all the same pluses and minuses of these quantum computing companies in terms of like being small, early, almost pre-revenue, but they're not trying to build their own quantum computer. They're more trying to be the CrowdStrike. And in December of last year, they were only listed in Canada or on the OTC in the US, and so they just recently uplisted to NASDAQ, but they were just sort of unknown. And so I noticed last fall, like after Trump got elected, like all the quantum, including a bunch of the de-SPAC quantum names like D-Wave and, Rigetti and IonQ, like they jumped something like 8, some of them were up like, from 50 cents to like $7-8 in 3 weeks after the Trump election. And I was thinking like, what is going on here? And then, I guess, the market's assuming that these guys Trump's going to protect these American quantum names against the Chinese and the North Koreans. He's going to support them somehow. So I guess that makes sense. And then I remembered this dinky little company up in Canada that I, stumbled on a few months before. I said, and there was one day where, in early December, I don't know what the reason was, but like all these quantum names were up like 20%, 30% in one day. And I remember looking at this Canadian listed company, and it was down 8% that day. And it was just because some random shareholder was dumping stock up in Canada. And that's how these things, and it had something like a $30 million market cap. Whereas these other names like Rigetti, I think was around like $1.5 billion market cap at the time. And everybody back then was howling, oh, this is ridiculous. It's signs of a bubble, and it's .com redux and all this kind of stuff. How can this happen? Oh, isn't this terrible? Same kind of stuff you hear now, except now that they're trading at, I don't know, 4 or 5 billion, probably 6 billion in some cases. So it's anyway. I built a position in BTQ. I started tweeting about it. I brought attention to it, and then the thing's gone on a huge run since. I think it's like a 30 to 40 bagger for me currently. So those are the two places. But to go back to your question about the de-SPACs, I mean, the kind of the art in finding these companies is obviously like, what's the difference between a Lucid and I don't know, like an Open Door or whatever, the Better Home and Finance, for example. Like that's, not all de-SPACs are created equal, and that's where I spend a lot of my time looking and under the hood, and we've built some AI models that kind of help us look for technical volume clues, or has something like totally capitulated. Are there fundamental clues to look for? Is there insider buying going on? There's never like one perfect like laundry list of 40 things that every one of these companies does, but there's probably about 40% of a list of, say, I don't know, 40 or 50 factors to kind of watch for. And if you see maybe 40% of them present, that's probably, the risk or reward is probably going to be in your favor in taking a position. But, Carvana had heavy insider buying all the way down in 2022. The CEO bought like $70 million worth of Carvana stock, first at $50, then at $20, en route to, this stock, bottoming in December of 2022 at $3.50. So he was, and I don't care, like people who say like, oh, well, he's rich and his dad was rich, so what does it matter? I mean, there's nobody that just lights $70 million of their own money on fire buying their own stock. And
Cat would.
So they had some other guys too on the management team buying, heavy stock. They had like a chief product officer. These guys are not, millionaires, zillionaires. The chief product officer bought $3 or $3.5 million worth of stock in Thanksgiving 2022 at $7.50. And if I was like to come home to my wife and like tell her, oh yeah, this company I'm working for, it's gone from 400 to 750. I want to take $3 million of our after-tax money from our IRA and plow it into the stock, where like 95% of my wealth is already tied up. Like that would have been, the difficult conversation. So, that was a sign of real confidence. But Open Door had just the opposite. It had like the CEO and the, head legal, general counsel, like dumping shares constantly for the year before I took the position. So there's never kind of like one silver bullet, list of things to look for. I mean, you do have to, put some human judgment into it, but no question that, the de-SPACs are a great place if you're looking for kind of left for dead, because to 100 bag, I mean, you want to find a company as cheap as possible, obviously.
Right. You're not going to 100 bag on buying NVIDIA right here.
Or Palantir. Right. Exactly.
Palantir. Right. You mentioned the Russell 2000. So I've always been of the opinion that that's like one of the worst indexes ever designed by man, just because it's got a lot of crappy regional banks, a lot of crappy biotechs. But my guess is your process, you'd be looking for stocks within the Russell 2000 that, that other people have missed, not just, hey, I'm going to buy the Russell 2000.
Yeah, I think so. I mean, it's probably a combo of like Russell 2000, ARK fund or something like that. I don't know. You guys have like a meme stock fund now. I don't know. I sometimes like Open Door got sort of swept up and called it a meme stock for a while. Although I would characterize it as a cult stock. I don't think you guys have started a cult stock ETF
Right.
yet. There aren't as
We
many
might have to.
as
Good
there
one. Good one.
But like, Tesla in the, last decade, Palantir, obviously, I think would be a poster child for a cult stock where, a cult stock is like a defensible business, like a real business where retail gets it first. Wall Street sort of poo-poos it and looks down on it. That definitely happened with Tesla and with Palantir. And so I think, we'll see. But I think Open Door is going to fall into that category of like, it's a real legitimate business now led by real legitimate, CEO and board members. And they want to try to, be the Amazon of housing and disrupt the, using the traditional agents, just like Carvana disrupted, going to the local car dealership to buy your next car and kind of have that direct relationship with you. So we'll see.
Why did Carvana get cracked so bad that first? How did it end up being so low? Was there some big fundamental shift that happened, and what was the shift that brought it up so fast?
I thought I was on a podcast 3 years ago where when tech was melting down, and they were asking me like, okay, like let's name some names. Which of these left for dead stocks are going to come back? And I named Carvana and Open Door at the time. And, I was like, this was June 2022. So I was like 6 months early for Carvana before they finally bottomed. But then they did, finally make the turn. They both had high debt. They both were unprofitable. So people sort of assumed both of them wouldn't be able to survive. And that's partly why the equity got so low. It's just that they thought, Carvana wouldn't be able to keep up with the debt payments, and the equity would go worthless. So, the difference was Carvana made the turn and Open Door never did. Open Door could never really seem to prove that they could buy and sell houses and sort of make money from it. Like Carvana doesn't make that much money from the buying and selling of the cars. They make something like 85% of their EBITDA margin from the finance and interest associated with the transactions. And so I always assumed that Open Door would follow that model, go into mortgage and title, attach that on, maybe some other ancillary revenues with it as well. And they had this woman leading them who, got appointed when one of the founder CEO left after they kind of, because they basically they bought a lot of houses in 2020 that they got stuck holding the bag on and had to, dump at a big loss. So he left. She was, elevated from CFO, and she was just like sort of a bean counter, but not particularly smart on tech or AI or anything like that. And she just, could never really prove that they could make any money from the model. And so people just sort of kept selling it down. Right. It got down, and then I think once it got below $1, a bunch of ETFs that owned it were sort of like forced sellers at that point or something. And so that pushed it further to like 80 cents, 70 cents. I mean, it got as cheap as like at 51 cents, it was like $397 million market cap. They had like just under 600 million in cash on the balance sheet. So, arguably too low, but, there was nothing to inspire confidence from that management team.
Right.
But they, I thought that they could turn things around, despite that track record. I thought it was just like too cheap. And they were sort of hinting that they were going to finally have their first EBITDA positive quarter in August, which they ended up having. It was the first one in 3 years. And so I was hoping that, I got into Carvana like a few years ago, but I got in like the AI model that we had at the time flagged it when it was $11 a share, not at $3.50 a share, in the December 2022. So, if you miss these things when they finally come back from the dead, like you got to be in early, and you got to be in before they've like proven profitability, because it's usually 6 to 8 months before there's sustained profitability. And the market sniffs that out, and sort of suddenly these things can go from like, in case of Carvana, in 6 months it went from like $3.50 to $25. So like almost a 10x in 6 months. So you do have to be early, and that can sometimes, you can catch a falling knife because these things, like the turnaround doesn't materialize. But so I jumped into Open Door. And I built my position at like 73 cents or something like that in July, and then announced it. And I said, I think this could be the next Carvana. I think like in a few years from now, you just take what Bloomberg is saying they're going to be doing, and from a revenue perspective, in 3 years from now, if you assume that their EV to sales multiple, because they didn't have profits, so you can't do EV to EBITDA. But if their multiple sort of starts to come back and rise the way that it happened with Carvana, then I made this case that could be an $82 stock by 2028. And I just I tweeted it out in mid-July, and almost immediately, 10 days later, the thing went from 80 cents to $5. And there was a day when it got halted because they traded like 2 billion shares, and they only have like 700 million shares outstanding. So it got halted for 3 minutes and all this kind of stuff. So it sort of kicked off like what became after that. There was like whatever American Eagle and GoPro, and then and then Beyond Meat. I was impressed that Open Door traded like 3x its float until I heard like a week ago or something Beyond Meat traded 10x its float in one day. So now there's a new king in town now.
So where are you at on this, Matt? This feels asymmetric, like you lose 70 cents, but you make 700 or whatever.
Well, yeah, I mean, when you're buying a stock at 70 cents, that's an asymmetrical trade. Limited downside, unlimited upside. I think it's interesting that, you're out there talking about what you're doing. I think that's great because you're doing some great research and you're letting people know. It's sort of like, the Kathy Wood model, except that your trades actually make money. Which is, helpful for any retail investors who are trailing you. So yeah, I think that's pretty cool to as long as obvious, and you're not. There are some people who abuse that, who will go out and say, "Hey, I love Open Door." At the same time, they're selling.
Right.
Oh yeah.
And interestingly, that happens a lot on the media, and the media knows it. This is an aside, but I was on a show a few years back, and they were joking, on a commercial, how they had a money manager on, the previous day touting a stock, and they knew he was selling it.
Oh my
So,
goodness.
I think that's awful. But, certainly, if you're out there doing some cool research, sharing that with people, I think is, I think that's awesome. I think, there's this whole new generation of investors on Twitter, and collaboration on Twitter, and in these discords, and so anti kind of traditional Wall Street, where I started, where I just I think the whole thing is really cool. So just my
Well, I was definitely surprised, pleasantly surprised, that there was just an enormous retail response to the Open Door thing, and so I've had a chance to interact with lots of people. So I guess one thing that was interesting was that I would say, I was on TV, I was on CNBC 2 years ago talking about Carvana. They didn't ask me to come on and talk about Carvana, because they generally ask you to come on and talk about the Mag 7. But then I was talking about Tesla, and then I kind of morphed the discussion freelance style into hey, and by the way, I just took a position in Carvana, through my AI model, and they actually, the producer called me up afterwards. Yeah, don't do that again. Nobody's interested in these small cap stocks. we just people only care about the Mag 7 on this channel. Okay, please, if you come back, can you just talk about Nvidia and stuff? And I was like, oh sure, sorry about that. But like there was no like response on Twitter. Like nobody said like, oh my God, like Carvana, this could 100x. I want to get into this now. There was just like silence.
Here's why, because everyone on Twitter is used to, I mean, A, they don't watch CNBC because they're not idiots, and B, they're used to people going on CNBC and being wrong.
Right.
Yeah. But then, conversely, so like when I tweeted out about Open Door, there immediately, I think it did help. Like people did say, oh, Eric, was early on Carvana. So like that sort of gave me some credibility in saying, I think this could be, a 100-bagger or whatever. But the most interesting second response was like people would say, oh my gosh, like I missed Carvana. I'm not going to miss the next Carvana. Like the FOMO was real, right? And like, and I guess the other really interesting part of the whole journey in terms of interacting with different people is that Open Door only operates in the U.S. and I would estimate like at least like 70% of the so-called Open Army, like the retail following, which started tweeting about it and talking about it and was kind of looking to me for what I thought about everything. I would say they were all outside the U.S. and they were, so, and sometimes they were, in a rural village in India but in general, middle class. And I would hear these stories from people, there was one guy down in Antarctica. I didn't even know people were living down there, let alone trading stocks down there. But they were all kind of struggling. And they would all say stories like, like I'm a painter, I'm an electrician, I'm a pipe layer, and I study stocks though at night. One guy was telling me I study like stocks 3 or 4 hours a night, and like this is the way that I'm gonna get ahead. This is the way I'm gonna kind of I'm gonna keep making my income from my job, whatever it is I'm doing, painting or whatever. But this is the way I'm gonna really like ratchet things up for me and my family and sort of get ahead. And so they were looking for riskier bets, but in a lot of cases they were very it sort of went against the typical Wall Street, narrative that you hear that all retail is dumb, they're idiots, they don't, they're just going to lose their shirts. Look at them trading money on Beyond Meat. What a bunch of rubes, like just give us your money already, okay? Give us the bips. You put it in VOOs. Put it all in VOOs. And
let me stop you. So you're part of something called Rising Dynasty, right? That's you've said it's not a club, a meme, or a hype cycle. It's a philosophy, a blueprint for the middle class to take back control of their financial future through self-education, self-discipline, and conviction investing, et cetera, et cetera. That's kind of where we are, right, Matt? And so why don't you talk about that a little bit, Eric?
Yeah, I mean, so I had to go over to Germany. I was like on some panel, and some guy like sought me out over there, and he's like, "I'm from Frankfurt. You're here in my town. Like, can I come and buy you a coffee because I made some money on Open Door?" And I was like, "Yeah, sure. I think I'm going to be free in the afternoon." And then I forgot to check my messages, and then this guy just showed up, and he's like, "Oh, I'm 31, and I'm I've got all these like struggles, and I'm I want to break into be a financial analyst. I'm in tech sales now." Anyway, he had his own like story, and I kind of hit me on the plane ride home, like, man, there's just a lot of people out there, and it's not country dependent. It's like globally, in the middle class, that are not they're not destitute, but they're not making it. And stocks, they see as a real kind of way out for them. And I wanted to encourage that. I wanted it to be bigger than just Open Door, because I wanted to inspire people to take an interest in the stock market and self-educate and all this kind of stuff. So and I know that like there's sort of I think we all kind of now have been trained on social media to kind of be a little jaded. The Kardashianization of social media, and everything is immediately leads to a course or a merch. It's like, here's how you can give me money, basically, if I'm some sort of influencer or creator. And I kind of, I know like a lot of people are kind of sick of that, I guess, especially in the middle class. And so I just wanted to kind of say, hey, I run a hedge fund. Like, I can't take retail investors. I got to take accredited investors. So, I can't really profit from, this big following, but I would like to try to hopefully inspire people, teach people, share some ideas, realize that everybody's going to make mistakes, myself included. But don't be scared of that. And hopefully, just keep going with this, because I think the stock market is infinitely more, I don't know, moral, healthy, productive than, wasting your time on sports betting, or one of these kinds of activities that so many people, especially young people, kind of fall into. So I wish I'd gotten that advice earlier on myself. So
What about launching an ETF in the U.S.?
Yeah, I mean, it's something I've, I certainly have heard people say that, and people have said, oh, here's Eric's picks, and here's how they would have done if they'd been constructed in an ETF. Right at the moment, I'm working on a crypto treasury or DAT company, which is, I hope it's going to be the first, what I call a Gen 2 version of a treasury company, because it's going to use our AI models to hedge. It's going to be multi-asset, so it's not just going to be single asset like so many of these guys that are either Bitcoin or Ethereum or something else. And it we'll use our AI models to know, like, when do we DCA into Ethereum, for example. Like, maybe because all of these companies run like monkeys, where, we raised 100 million, we're going to buy 100 million of Ethereum. Well, that wouldn't have been so smart in January if you'd like dumped everything into Ethereum, and then by April 23rd, you'd have a $42 million treasury company. So, I think AI can help with that. AI can help with hedging, obviously. We're going through some volatility right now in the crypto markets. So my focus has been on getting that launched. Hopefully it will before the end of the year. We'll see what happens with the other ideas like ETFs or whatever.
Keep us up to speed on the DAT. We're doing a lot of 2X's on the more popular ones. So we just did BMNR. It's getting its butt kicked. I mean, it got over 500 million in AUM in like a week. Right now it's 400, but that's just because it's getting killed. But we've done UPIXI and SBET, obviously MicroStrategy, and we filed for a bunch of them. And we see a lot of interest in Korea for this stuff, and we do a lot in Korea. So definitely keep us up to speed. We're also going to be partnering on a actively managed DAT ETF with another group. So this could be there could be some nice fits for that.
So Eric, I've had this SANA up here on the screen for like the last 20 minutes. That's one of yours too, right? Let's just make sure this is one of yours, right?
Yes, it is. Yeah, Sana
Tell us
Biotech.
about this.
Okay, so I mean, if you believe us, like, that the rate cuts cycle has just started. We're two in, and it's going to continue for the next several years. And that Matt mentioned like how we've seen these SPAC companies come back from the dead in the last few months or whatever. The Russell's done well. So I think part of the broadening is also going to include biotech, and you're going to see some, the XBI and things like that do well. So, but obviously, like, if you pick the right individual names, you can do particularly well. I mean, Kathy Wood has sort of fished in those waters, different individual stocks, over the years. I mean, this one is kind of like close to home for me because it's it's basically taking a stem cell approach to kind of developing new drugs. So it's a platform play if it works, if they're able to kind of prove that their stem cell approach is better. But the kind of the first place where they're really going after is type 1 diabetes. And so I have 4 kids, and my one of them has type 1. So I know that basically you stop being able to develop insulin for yourself. They've developed basically a treatment. So it's like a one-time treatment where they can basically retrain the body to start producing insulin on its own. So you don't have to wear, a different like Dexcom glucose monitors and another device that injects you with insulin during the day. You can retrain your body to basically get over type 1 diabetes. Huge market. It's only $1 billion market cap today, probably less than that now. It's pulled back in the last week or so. But they have had some successful human trials, but still very, very small, like a handful of folks. But they've sort of, the excitement earlier this year was that they were able to show that they were, able to cure type 1 diabetes in these humans. So now they're the next milestone for them is they've sort of indicated that by next year, 2026, they're going to file something called an IND filing, which is sort of a more concrete, comprehensive plan on how they plan on rolling this out or proving this in bigger populations before approval. So if it works, which could still be years away, this is a 100-bagger for sure. It could easily be $100 billion plus market cap company. So it's not going to move. It sort of moves when you wake up one morning and there's some FDA type of announcement. So it's some people that will appeal to, some people it won't. But it is it's part of my rising dynasty portfolio because I do think they will be successful. As time goes on.
Got it. So how do you position size these, man? The thing's up 97%. Do you scale back, or do you just let it ride? And not 97%, 97-fold, I guess would be the better way to phrase it.
You're asking me how do I?
Yeah. How do you position size?
So for me, I guess one of the things that I learned trading Carvana stock as it 100x'd. I guess there's a few things I learned from that whole experience. One is that you obviously, to truly capture a 100x opportunity, you got to get in as early as possible. One. Right. And then I guess the second big learning was that these things are volatile as hell. And you have to be prepared for major drawdowns. So I got into Carvana at $15 a share, and between 15 and about 150, which took a year, I think there were 3 separate occasions where it had major drawdowns, and the biggest one was like a 66% drawdown, if I recall.
Right.
Which in 10 days, which did not feel good emotionally, like when you see all these paper profits evaporate from your account that quickly. And so emotionally, your response is to react and to get, but then you get into the problem of, you get out just as the thing is near its, drawdown, and it bounces back. So anyway, long story short, I sort of said to myself, okay, if I'm going to do the 100 baggers earlier this year as sort of the core focus, I'm just going to do the research up front, find these opportunities, just sort of buy a big chunk of equity, 5 to 10% position, assuming that over time I'm going to build out a portfolio of 10 or maybe max 12 names, and just keep it. Just sit on my hands, don't touch it, and hope that I get the initial bump, like what I experienced with Open Door. So there's a little profit, in the portfolio, a little padding that you're playing with, but then realizing there will be drawdowns, but hopefully you're adding new positions to the mix that have their own successes and can make up for any short-term pullbacks that you might be seeing in some of these other positions. And when it's available, look to buy some longer dated, out of the money options, call options on these names, and not bet the farm, but just hold those and again, don't touch them. So that's what generally how I've been operating things this year. And Sana is not it's not the same as an Open Door, because with Open Door you expect a regular cadence of at least the earnings calls and announcements, product announcements, new partnerships and so forth. There are going to be fewer of those events that will lift up a name like Sana. So it's it's probably a smaller position compared to some of these other names. But again, you sort of let it sit there, don't touch it. Don't use it as liquidity to just keep it off on its own.
Would that fit in an ETF, Matt? Like, 12 stock, 12 100 baggers? Could you do that?
It would be difficult with the diversification rules, but it could be done. Typically, if you're going to have like a smaller amount of holdings, you do that through swap, and you could make it work that way. Options are fine as well. So yeah, I mean there are always ways to make it work.
Could you do it with flex options, which we've discussed? Yeah.
I mean, you don't need to. There
Okay,
are certain reasons why you use flex options, but no one in their right mind would use a flex option if they don't have to. I mean, we're dealing with flex option hell right now. It's more the wild west.
Got it. So, all right. So I'm going to switch up here. Let's go like another 10 here. So, I just pulled up this thing about themes, right? And it is youth disillusionment, anti-institutionalism, option market democratization, like zero DTEs. That kind of fits into all this, right? I mean, that's what we're saying. Yeah. The youth don't want to listen to Wall Street anymore. They want to buy like good stuff, right?
Yeah. Like obviously, like when I look back on my own career, like when I had bad 2021, 2022, because I wasn't, I didn't have this 100 bagger philosophy, but I was certainly, focused on smaller to mid cap growth tech companies, and they all got like their heads handed to them in those years when inflation was rising, and I was. And so obviously, like I had too much long exposure, but the thing that really killed me was option exposure at that, long option exposure at those times. So you can really, if you really want to incinerate money in your portfolio, it's being heavily leveraged onto options when it goes against you, obviously. And so I don't like zero DTEs, I think there's I'm advocating, as part of like my mantra or philosophy, Rising Dynasty, to try to, to take, I think you do need to take risks. I mean, it's not going to move the needle if you have like a 0.5% position in a Carvana, even at the lows. Like you're going to you have to do what you're comfortable with, but sort of like a meaningful, 5% position or, 10% if you really have conviction. So you do have to take risks. But I think there's a difference between, that kind of educated risk and like stupid, option risk, excessive risk. So,
right.
But anti-institutionalism for sure, anti-Wall Street. Wall Street looks down on us and we're really smart. We're retail, F you guys. We're going to show you we can do it. That's definitely part of the philosophy.
Yeah, right.
And it's, in my opinion, it's true. I remember a couple of months ago, I had a hedge fund manager call me. He's like, yeah, we found this new area, nuclear stocks. I'm like, dude, I'm already taking profits. You're not exactly cutting edge here. All of the discords I'm in have been in nuclear stocks for like 2 years, and you've just discovered them.
Right.
Yeah, so I do think there is now this whole generation of retail investors that learned over COVID, and now the smarter guys on the institutional side are trailing them. I mean, I think Melvin Capital learned the hard way that you guys aren't necessarily the smart money anymore, and I think you've got a lot of people now that are paying attention to what the smarter retail guys are saying. And we talked with Market Sci on one of the podcasts. It's not as simple as hey, everyone's talking about Apple, but there are some real smart guys on Twitter and in these discords, and talk about 100 baggers. I mean, a lot of these guys I follow are up ridiculous amounts year to date that would blow away any hedge fund on Wall Street, and not doing it taking ridiculous risk either.
Mm-hmm. Yeah, no.
So
the guy in Germany, this 31-year-old, like he worked in inside or tech sales, and he was telling me he's on some Discord group with some like heavyweight hedge fund managers, and the hedge fund manager, the most famous guy, didn't tell me who it was exactly, was like copying all his trades this year, and like sort of trailing him on these kind of key trades that he was seeing about like AI, data center, networking plays that are kind of like off the beaten path, so yeah, I mean, there are great ideas everywhere. I mean, obviously, you got to do your own research and suss people out, but there are some amazing people out there freely sharing their ideas because they're kind of looking to make a name for themselves if you put in the time.
So you talked about this yesterday, IREN, a little bit. You were on Charles Payne yesterday, no? He's one of our guys. So you talked about IREN and Cypher and all that. What do you make of all that? Is there anything new? Any new info out there?
Well, it's actually the IREN and Cypher were my first two 100-bagger plays earlier this year before Open Door. When in the spring, I kind of had this like come to Jesus talk with my little 6-person AI ML engineering team that I have at my firm, and I was like, guys, we're trying to build like 8 different kinds of models. It's like we're not like Cotu here. I don't have like billions to like support you guys. Like we got to focus in on what's working, and so let's focus on the 100-baggers. Let's focus on crypto models that show some promise. And the first two names that we came out with were on Twitter were IREN and Cypher, and that was in June, I think. I think I started building the position in late May, early June, and back then they were the thesis was these are Bitcoin miners, but they were making this big move into AI HPC, and the market doesn't appreciate it yet. And what's different about IREN and Cypher is they've got the most gigawatts, the soonest in their pipeline that they're gonna get energized in the next 12 to 18 months. And so they each had 3 gigawatts each, sort of near term in their pipeline. And the thinking was like, everybody and their brother, all the Mag 7s, or every earnings call, they're announcing they're increasing their capex by another 10 billion next quarter on top of whatever they're doing this quarter, which is like 60, 70 billion. And that's fine and dandy, but you've actually got to go out, buy the real estate, negotiate the energy contracts, build the data centers, buy the chips, obviously, and kind of get these things turned on. And so my thought was like IREN and Cypher are going to be ready sooner, and they're obviously then ready to make deals with all these different players. And so we saw like the CoreWeave interest in Core Scientific, a deal happen, but it was Core Scientific is relatively small, like it's sort of like 200 megawatts, whereas like IREN and Cypher, we're sitting on like 3 gigawatts each. So I didn't know when they were going to have some sort of re-rating, but I assumed that like the Oracles of the world with their interest in Project Stargate and OpenAI were going to probably do a deal before the end of the year. A lot of people would do deals before the end of the year, and now we've started to see that kind of materialize. Probably the biggest one so far has been maybe Nebius with Microsoft. That was a 1 gigawatt deal and for one data center in New Jersey, but obviously it kind of doubled Nebius' stock like overnight. It's worth like, I think it's like 18 billion over 6 years or something like that, 3 billion a year. The deal yesterday with IREN and Microsoft was only for 200 megawatts, but I think it was worth 6 or 9 billion. I can't remember. Anyway, so I think that like it's a game of musical chairs is happening where there's still deals to be done, and probably the price is going to keep going up. And CoreWeave has sort of been a golden child. They did a March IPO. I think they're up 4 or 5x from their IPO price. Right. But the thing about them is that like they're middleware. They're sort of stuck in sort of this no man's land between the hyperscalers and the actual people with boots on the ground that have actually the rights to the data centers and the real estate and the energy connects and all this. And so they have to do deals with the IRENs and Cyphers and Core Scientifics and TeraWulfs and others. So I think over time, like IREN and Cypher are going to sort of overtake CoreWeave in terms of market cap. And I should say, like I also remember listening to Spaces in May by Mike Alfred, who's like an outspoken Twitter guy, and he's on the board of IREN. He's a shareholder in Cypher, I mean, he was very bullish even back then. Now, just because he's bullish a lot, but I did sit up and take notice. I remember during his spaces in May when he said something like, I didn't join the board of Iron, back in, I think he joined in 2021 or something, when it was like maybe a 1 or 2 billion market cap company. He was like, I didn't join this board to be on like a $10 billion market cap company. Like, my hope is like one day this is going to be a $500 billion market cap company. And so, just hearing that there are people, part of this, on the boards of these companies with those kinds of ambitions, it doesn't mean it's a done deal, but, to make something happen, you got to have that belief system from the people at the top. And so that definitely caught my eye.
All right, last question. So any natural gas names? I mean, I was just Jerry Jones. I mean, Dallas Cowboys owner said like there's billions of natural gas out there. I mean, any natural gas names in your radar?
Not at the moment. I mean, I'm more of a tech guy, so I don't sort of look at the nat gas like pure plays. I mean, I get people now pitching me ideas all the time. How about this energy infrastructure, that energy infrastructure? So I have sort of a list of names that I'm kind of working through. So energy. There's definitely an energy shortage, though. So like that benefits names like Iron and Cipher, and so I'm sure it would. Some nat gas plays out there, but nothing right now.
All right. So Matt, any more questions, man? Anything else?
No, I think I'm good. This is
so Eric, where do we find you? I can put up your website, or what's a good spot for you? Where would people go look
on
for
X?
You? Twitter?
Yeah, X at Eric Jackson. It's pretty straightforward. Eric with a C.
Hold on.
And then my fund's website is emjcapital.ltd, like limited.
If you ever want to do an ETF, let us know. We do a lot of ETFs for other
There
people.
he is, right there. All right, You guys see that? Yeah.
Okay.
All right, sweet. Okay.
Yeah.
Appreciate it, man.
All right.
Thank
Yeah,
you.
will
Thanks,
do.
Matt. Thanks, Eric. Have a good day, bud.
All right.
See you.
Thanks, guys.
Thank you, guys.
Bye.